Welcome, seeker, pilgrim, friend, to the temple of the dividend discount model. Here you will learn the timeless secrets that will guide you on your path towards stock selection enlightenment. Well, I know, it's a little silly, but isn't that the way this seems? Doesn't it seem a little bit like Sanskrit and mystical, magical? No, it's not. It's really not that sophisticated. The calculations are actually pretty darn easy. What people have trouble with is, what am I calculating? As we discovered in the first presentation, the calculations were pretty darn straightforward. The price models are actually easy to calculate. The question is, what am I calculating? Oh, right. I'm just looking to see what would happen if the price to earnings ratio or price to cash flow ratio or price to sales ratio stays the same, and the sales increase or the cash flow increases or the earnings increase by a certain percentage. And so we're going to find that the calculations for the dividend discount models are pretty darn straightforward also. They're not that hard. What's a little tricky is understanding what you're calculating. And after you do it a few times, folks, I promise you'll go, oh, I understand. This is what happens if the dividends keep increasing, or if these are the dividends we receive over the next 3 or 5 years, and then the price of the stock, that's what happens to it. And those are big ifs, as we discussed in the first presentation. Yes, we're just tilting the odds in our favor, dear students. We're not telling you that this is exactly what's going to happen. We know it's not going to happen. We know that. All we're doing is trying to see which way the wind is blowing and moving the needle a little bit in our favor so that we will wind up purchasing stocks, the vast majority of stocks I recommend in your portfolio, that should hold up during hard times but still do reasonably well in the good times. And folks, we're actually going to look at a few that could fall precipitously but make us very, very wealthy. And that's what the most important thing is. You know what you're investing in. You understand that this indeed could make me very wealthy or make me very sad. Or this stock, it's not going to make me rich overnight, but it's going to hold up well when the organic matter hits the ventilating device. So let's begin on slide 17, the dividend discount models. These models believe that the shares of stocks are valued on the basis of the present value of the future dividend streams the stock is projected to produce. Relax. They're also called dividend valuation models, discounted cash flow models, DVMs. If you recall from the first presentation, we said that the value of a stock is based on the present value of its future cash flows. In other words, what is the stock bringing in to us in the form of earnings, in the form of dividends, which, earnings are great, but we investors love dividends. During the 1990s, investors who adhered to these types of models were considered old-fashioned, outdated fuddy-duddies. Yeah, they used to be popular, but no, now, in the 1980s and 1990s, growth was what we wanted, right? Well, what happened? Those investors who were fuddy-duddies and outdated and followed these models weathered the 2000 to 2002 downturn very well. How did they do in 2008? Well, everybody fell down, right? Dividends, though, have become important to many investors. Why? Because dividends don't lie, dear students. Slide number 18. The dividend discount model in its purest incarnation. The value of the stock is equal to the present value of all expected future dividend payments. Oh, look at that. It looks like math. Well, folks, it's really not that difficult. It's just they make it look scary because they use all these math symbols. But the price at time 0, isn't that cute? P sub 0 is equal to the dividend in year number 1 divided by 1 plus K. What's K? Well, in baseball it stands for strikeout, but no, in our case, that's the required rate of return. What are we interested in returning? 5%, 10%, 15%? Yes. We decide on what the value of K is. And that's sometimes a little difficult for students to get their heads around. But in other words, we're saying, what do we want out of this stock? We want 5%, 8%, 9, 10, 11%. Anything above that, dear students, and I'm suggesting to you that you're risking, you're being speculative. And you might win and you might not. But we do that for the first year. The dividend for year number 1 divided by 1 plus K, 1 plus 10% or 1 plus 5%. And then we do that again for year number 2, the dividend in year number 2 divided by 1 plus K squared. And then the dividend for year number 3 divided by 1 plus K to the third. And we do that until however many years we want to do it, 5, 10, whatever. I'm going to suggest to you that 3, 4, or 5 years is about as far as you can look into the future, but some people might look further. And the example on page 181 of the 7th edition, it's about the same page no matter, whichever edition you have. It's somewhere in the beginning pretty much of chapter 6. We have a company that pays 3 annual dividends of $100 per share and then promptly goes out of business. If our required rate of return is 15%, now remember that's a pretty high rate of return. I disagree with the authors on that, but let's say it's 15%. We take $100 divided by 1.15, 1 plus 15%, plus $100 divided by 1.15 to the second power, plus $100 divided by 1.15 to the third power. And if you do all those calculations, you don't have to. They're already done for you. That tells us that the company is worth $228.32. Those 3 annual dividends of $100 per share are worth to us today, if we require a 15% rate of return, $228.32. But how many businesses pay 3 annual dividends and then go promptly out of business? Plus, Payano, you keep referring to this term present value. What does the present value mean anyway? Slide number 19. Present value is the value of a lump sum or a series of payments to be received at some future date. It is the opposite, the inverse of future value. Did you work on the optional future value calculations in Chapter 1? You didn't have to. At least go back and look at the answer key. In the future value, we start from today and work towards the future. The present value, we do the opposite. We go into the future and then come back and bring it back to the past. Now remember, do we know what's going to happen in the future? No, we can guess, and we may be right. We're pretty much certain that we're not going to be right. But we're going to make our best guess estimate. And so here's 2 sides of the same coin. If I have $10,000 today and I want to put it away for 10 years at 8%, what's it going to be worth in 10 years? Well, I take $10,000 times the future value multiplier. Now, where did I get that? I could use the exponential formula, but I don't need to. I just go look it up in the table. And it turns out that $10,000 at 8% in 10 years will be $21,589. There's the formula if you want to use it. What if I know or I believe that in 10 years I'm going to have $21,589? What is it worth to me today? Well, that's the present value calculation. We multiply the $21,589 times the present value multiplier. And where do we get that? We look it up in the table. Or you can do the calculation, the exponential calculation. And it turns out that the $21,589 that I believe I'm going to get in 10 years at 8% is worth to me today $10,000. Present value and future value are just two sides of the same coin. In finance, present value tells us what the future value is worth now. And I know it's a little tricky to get your head around, but let it sink in. As we do the calculations, I truly believe you do these enough times, you'll understand exactly what you're doing, because it's really not that hard. Once you've done it a few times, you go, oh, I see. Would I rather have $10,000 today or $21,589 10 years from now? Well, if my required rate of return is 8%, they are the same. $10,000 today is the same as $21,589 in 10 years at 8% average annual return. Cool. So, let's go back to that scary formula on slide 20. Did the formula scare you? Well, the formula has the present value calculation built into it. But we mortals simply use the present value tables, just as we would have used the future value tables in Chapter 1 if you had done the calculations. So now the formula becomes the dividend in year number 1 times the present value for year number 1. Present value multiplier, plus the dividend for year number 2 times the present value multiplier for year number 2. Plus the dividend for year number 3, plus the present value multiplier for year number 3, etc., etc., etc. And again, the present value multiplier is something we look up in the table, so you don't need an exponential calculator. I told you you didn't need one at the beginning of the semester. All you need is a 99-cent calculator from the dollar store. Slide number 21. Let's do the same example over again, using the present value multipliers from the present value tables on the class website. So now I want you to print this out. I mean, you can certainly look at it on the screen, but it really does make your life easier if you have it printed out in front of you and can refer to it when you do these problems, all right? And of course, in the face-to-face class, I give them out to the students. So if you go click on that link and print out a copy, it'll make life a whole lot easier for you. So again, it was 3 annual dividends of $100 per share. The required rate of return is 15%. So you multiply the dividend to get the value. You multiply the dividend in year number 1 times the present value multiplier for year 1 at 15%. You go across 15%, down 1 year, and you'll see it's 0.870. So $100 times 0.870 is $87. Would you rather have $100 today or $87 a year from now? Well, if your rate of return is 15%, they are equivalent. It doesn't matter. For year number 2, it's $100 times 0.756. Now, make sure you can do this, folks. Just don't take my word for it. Print out that table, go across 15%, down 2 years, and see if you don't get 0.756. And that's $75.60. And then the year number 3, it's $100 times 0.658. 0.658 being the present value multiplier for 15% at 3 years. For 3 years at 15%. Go across 10%, down 3 years. You add those 3 up and you get $228.40, which is very close to what we got a few slides ago. And why is there a difference? Well, because the tables don't have as much accuracy as your calculator. Your calculator has 20 digits of accuracy. This only has 3. So it's off by 8 cents. Big deal. All right. So reading the bottom together, what is the present value of the future stream of dividends that we receive from this company? Well, at 15%, $100 in year 1 is worth $87. In 2 years, it's $75, that $100. And in 3 years, $65.80. The sum, $228.40, of the present values of the future dividend cash flows equals our perceived value of the stock. Always remembering that are these 3 dividends guaranteed? No. No. Remember, ain't nothing guaranteed in stocks except that they're going to be volatile. So you have to remember that this is simply what we believe is going to happen in the future. It probably, we're almost guaranteed that it won't happen exactly the way we believe it'll happen, but depending on the company, it should be fairly close, unless there's a nuclear war, we die in our own waste, a meteorite, earthquake, tsunami, Ebola, disco returns. Yeah. Slide 22. So let's go through some of the more popular versions of the dividend discount models, because there are more than one. There's more than one, folks. And then there are other models that we're not even going to get to. But remembering that they're all variations on the same idea, and after you've seen the price models and the dividend discount models, you should be able to pick up all the others fairly easily. And of course, if there's time, which there usually isn't at the end of the semester, we could sit down and play with a few. Okay? So let's take a look at slide number 22, the zero growth model. This one's not covered in our book. Well, it is. It's a special case of the next one. It's a special case where the dividends are not growing. This assumes that dividends will continue at a fixed rate indefinitely into the future. And how do we calculate this? It's a simple calculation, folks. We take the annual dividends and divide it by the required rate of return. Remember, the required rate of return is what we believe we want. Everybody's required rate of return is different. So here's the example. $3 a share, this company has been paying every year for the last several years, and we expect it to continue to pay that. If our required rate of return is 6%, that's ours. We decide that. $3 divided by 6% equals $50 per share. So we believe the stock is worth $50. Now, what if our required rate of return were 8% or 4%? Obviously, you see what happens? The model says something different. Does this zero growth model look familiar? It should, because it's simply another way to view the dividend yield. Slide number 23. Here's our dividend discount model, the zero growth model. The value of the stock is equal to the annual dividends divided by the required rate of return. The dividend yield is the annual dividends divided by the market price. So really what we did is we swapped these two. We swapped value of the stock with the market price, and we swapped the required rate of return with the dividend yield. So it's basically the same idea. The dividend yield is what the stock is actually paying. The value of the stock is what we believe it's worth if it were paying our required rate of return. And if you didn't understand what I just said, don't worry about it. Just do the calculation. Investors who emphasize the zero growth model are valuing the stock almost exclusively for its dividend yield. I'm not worried about growth. Remember the equity income mutual funds? I'm more interested in dividends. Dividends don't lie. Okay, so here's a real-life example on slide number 24. Consolidated Edison. The symbol is ED, and that came along many decades before the ED meant something entirely different, and companies like Pfizer started selling Viagra. So, my apologies. This is a real-life example. ED and Consolidated Edison is the utility for New York City, right? It goes back back to the 1800s. This is a utility income stock, and the current market price as of the 2nd of March 2018 was $74.35. They're currently paying $2.86, and they rarely raise their dividend. It happens, but no, we can reasonably assume that people in New York City are going to want to take hot showers with the lights on. They're not going to want to take cold showers in the dark. So they're going to be using their gas and electric. So we're going to get our $2.86 every year. What is our required rate of return? Well, let's first use 8%. Okay? If we divide $2.86 by 0.08, 8%, we get $35 75 cents. Well, the stock is overpriced if our required rate of return is 8%. Well, let's lower our required rate of return, huh? Can we do that? What about 5%? Well, then the price we believe it would be worth is $2.86 divided by 5%, 0.05, or $57.20. Yeah, the stock is still too expensive if our required rate of return is 5%. Yeah, well, this is what's happened with dividend-paying stocks. Because bonds are paying so little, people have bid up the prices of income-oriented stocks, and so their prices, in my humble opinion, are pretty darn high. Now, are they going to stay that high? I don't know. That's why they call it the future. But my guess is as bond yields rise over the next few years, which it looks like they should, there are people who are saying they're going to skyrocket. I don't believe them. There are other people who are saying, no, they're really not going to go up that much. I think they're being a little over-optimistic, but that's why they call it the future. But as bond yields rise, which they most likely will, we probably will see the yields on these stocks rise, which means the price is going to go down, right? The zero growth model works well for stable income producing stocks. Cool. Now, here's one of my favorite models. This is called the constant perpetual growth model. It kind of reminds you of the Department of Redundancy department. Isn't constant and perpetual pretty much the same thing? I don't know. Anyway, we're going to assume that dividends will continue to grow at a specified rate perpetually into the future. So this is really the previous model, but we've added a term here. Whereas the previous model took the annual dividends divided by the required rate of return, this model adds this term, annual dividends times 1 plus the growth rate of the dividends, and then it adds this term on the bottom, required rate of return minus the growth rate. You see, that this model is actually the overarching model. If our growth rate is 0, then this model is the same as the previous model, because 1 minus 0 is 1. 1 plus 0 is 1. And 1 times anything is that, so you get annual dividends. And if you subtract 0 from anything, you get the same thing, so required rate of return. So this is the same model as before. It's really, the previous model is just a special case where dividends are not growing. So in the 6th edition, here's the example they use. And it's the same example in all the other editions, it's just on a different page. The annual dividend is equal to $10 per share. That's what this company is paying. And they've been growing their dividend at 5% a year. So that means next year, 10% times 1 plus the growth rate. This should look fairly familiar, right? That means next year we expect them to pay us $10.50. Our required rate of return, again, is way too high, in my humble opinion, at 15%. So you take 15% minus the 5% that they've been growing, and that's 0.15 divided minus 0.15 minus 0.05, or 0.1. So $10.50 divided by 0.1, 10%, gives us $105 a share. So we believe the stock should be worth $105 a share. Now, all you have to do is change your change your required rate of return, and you're going to get very different numbers, as we'll see when we continue on slide number 26. Slide number 26 is another real-life example. This is a very popular company called 3M. Huh? I've never heard of 3M. The symbol is MMM. They've been around for decades, folks. You know, they used to be called Minnesota Mining and Materials, but they thought that was too old school and stodgy, so they changed their name to 3M. Yeah, what do they make? You ever hear of Scotch tape or Post-it notes? Yes, you have. Yes, you have. And they make a whole lot more different types of products. I think either 10,000 or 100,000 different products. Most all of them are flat. Like stuff that surrounds your house to keep the moisture out. And reflective tape and the like. Their current market price is $230.37. Oh, by the way, they're in the Dow Jones Industrial Average. $230.37 on March 2nd, 2018. And they're currently paying $5.44 in annual dividends. Let's assume that dividends have been growing around 8% per year. If our required rate of return is 13%, then how do we do the calculation? Again, the calculation is pretty straightforward, folks. Take the annual dividends and multiply it times 1 plus the dividend growth rate. That's 8%, so 1.08. Divided by the required rate of return, 13%, minus the dividend growth rate, 13% minus 8. And you do that calculation, and you get $117.50. So, if we require a 13% rate of return, we don't think it's that great a deal. But let's change our required rate of return down to 10%. $5.44 times 1.08 divided by 10% minus 8, and we get a little over $5.87 divided by 0.02, and that gives us $293. Almost $294. Note that the model is very sensitive to our choice of our required rate of return. And this is why it's called a stock market. Everybody looks at it differently and says, I want 13, I want 10, I want 5%. And so they're willing to bid up prices up and down that risk versus return spectrum. Slide number 27. Honeywell. Who? Honeywell? Do they make honey? No. They're an industrial company. And they used to be part of the Dow Jones Industrial Average, but not anymore. Have you ever noticed who built the thermostat in your home? Yeah, well, lately they haven't been pushing that business as much because lots of high-tech companies are getting into the act, and they want to be able to know what's in your refrigerator and I don't want a smart house, folks. I don't want one. But anyway, they make industrial products, specialty items that are process control and all types of devices that we don't think twice about, but we use them all the time, such as thermostats. And their current market price is $148.14 as of March the 2nd. They're currently paying $2.98 in annual dividends. And again, let's assume that they're growing their dividends around 8%. If our required rate of return is again 13%, that's $2.98 times 1.08 divided by 13% minus 8%. Do the calculation. It's not hard, folks. Make sure you do it right. Notice the parentheses. You got to do the division last. You can't do the division before you do the two subtractions. And ask your math teacher why that is. It's because it's not commutative. Okay, 3.2484 divided by 0.05 gives us $64.37. Oh well, Honeywell doesn't quite measure up at 13%. But what if our required rate of return were only 10%? Run the numbers again. $2.98 times 1.08 divided by 10% minus 8%. Do the subtraction, the multiplication first, then do the division. And you wind up with $161 almost. The model says that Honeywell is undervalued if we require only 10%. We believe it's worth $170 if our required rate of return were only 10%. Cool? Do it. I know. You're just looking at it, but I want you to do it. I want you to do these calculations because, as we said, they're not that hard. You do them enough times and you will, poof, I can do this. And I'm going to ask you to do them a whole bunch of times. In fact, they're going to be on every exam for the rest of the semester. So you might as well learn it now. Slide 28. The Target. Target. That fabulously exclusive French department store, Target. Yeah, domestic large cap retailer. The current market price as of March 2nd, $75.15, and they're currently paying $2.48 in annual dividends. Again, let's assume that dividends are growing around 8% a year. Our required rate of return is 13%. 2.48 times 108 divided by 13% minus 8%. Do these calculations, and you'll find that we think the target's only worth about $54. So much for being bombarded by the color red, huh? What if we simply reduce our required rate of return to a more reasonable, realistic 10%? Then what we see is $2.48 times 1.08 divided by 10% minus 8%, and we think Target's worth almost $134. Yeah, I know, Target does not have a reputation for being the most elegant store in the neighborhood. They're not even international. They're mostly based in the United States. But hey, it's pretty darn profitable, folks. So it is at least worthy of your consideration. Indeed. Slide 29. Pfizer. Who are they? Only one of the world's largest drug companies, right? And no Viagra drugs, please, folks. Current market price is $35.95, 2nd of March 2018. Currently paying $1.38. Let's assume again that the dividends are growing around 8% per year. What if our required rate of return is 13%? You know the drill. Do it. Pfizer does not look so good if we want 13%. But if we rerun the numbers with a 10% rate of return, then Pfizer appears to be a pretty darn good deal. Do people stop taking their medications just because the economy is in recession? No, you need a statin, you take a statin, even though you'd much rather lower your cholesterol in much more non-pharmaceutical ways. Like stop eating the bacon and exercise out there. But you need your statins, And that's what drug companies can deliver. Now, they're always in danger of running out of patents and having to come up with new drugs and charging people outrageous amount of money. And our healthcare system is broken. Yes, I know, but nobody can agree on how to fix it. So this is what we got now, right? You never know. It might change someday. I'm not holding my breath. Slide number 30, Altria. Altria, well, you might know them as Philip Morris, but they changed their name a long time ago. And don't confuse them with Philip Morris International, which Altria spun off. That's the international company that's actually based in the United States, but only sells their cigarettes outside the United States. Altria is the company that sells the Marlboros and the Virginia Dims inside the United States. And it used to own Kraft, and it used to own Nabisco, and it used to own Miller, and Post Cereal, and Boca Burger, Oscar Mayer, but they spun all those off, and they're left with tobacco in the United States. And their current market price is $62.55. They're currently paying $2.64 of annual dividends. And again, let's assume the dividends are growing around 8% per year. Same required rate of return of 13%. And at 13%, the model says it's worth about $57. And $62.55, it's not a good deal. But if we simply lower our required rate of return to 10%, then it turns out we believe Altria is worth $142.56. What a buy! If you conveniently ignore the fact that tobacco kills 400,000 Americans every year, would you invest in a company whose product, when used as directed, kills its consumers? Yeah. In fact, it's been a darn good. In fact, it's been a phenomenal investment, as long as you don't smoke the darn things. Would you buy Altria? You have to decide, dear students. Sometimes we buy the stock and stay away from the product. Sometimes we buy the product and stay away from the stock. Okay, let's continue. Oh, who's that? Who is that?
No.
Yeah, who are you?
You know who it is.
It's my conscience.
Come clean.
Come clean about what?
Fess up.
Fess up about what?
Where did you get the assumed dividend growth, huh?
I made them up.
Huh?
I made them up. All these companies are growing their dividends faster than 8%.
That's better.
Oh, I hate it when my conscience gets involved. Yes, dear students, the constant perpetual growth model is very sensitive to the assumed growth rate of dividends. The recent dividend growth rates of 3M, Honeywell, Target, Pfizer, Altria are all 8% or higher. Pfizer's 8.9, Altria 9.7, 3M 11.7, Honeywell 11.8, and Target recently has grown its dividends at 18%. But the model does not work well if the required rate of return is equal to or less than the dividend growth rate. You get very strange numbers, division by zero or negative prices. Therefore, we should actually raise our expected rates of return for all of these companies. All of these companies are actually better buys than what the model is telling us for at our 10 or 13% rates of return. But if you're growing your dividend at 18%, can you reasonably expect that the price is going to grow at 20% or 20? It's too much to expect. But because of this, as I've said in the past, I am very optimistic about the future of investors in the stock market. Yes, prices are elevated, especially for some very outrageously priced companies like Netflix and Amazon and Tesla. But for companies as boring as Honeywell and 3M and Target, you're not going to get rich fast, folks. No, we've said that in the past. Those companies aren't going to make you very wealthy very quickly, but they're going to make you very wealthy. And they ain't alone. They're not the only ones. These are blue chip companies with long histories of rising dividends. ExxonMobil, check out Procter & Gamble and Johnson & Johnson and Abbott Labs and Johnson Controls and United Technologies and Intel, Microsoft and Ford. They're out there, folks. You don't have to buy, you don't have to feel that you have to own Google and, Facebook and Netflix and Amazon and the companies that they talk about every day in the news. There are thousands of them out there, folks. And there are a lot that have been chugging along, boring old companies whose people use their products every single day. Yeah. Slide number 32. The constant growth model. Ay, Paquito, do we have to do this? No. I'm just showing it to you because the book shows it to you. And the idea is that we're going to assume that dividends will grow at a specified rate for a specified number of years. And really all they're doing is getting cutesy. Here's the constant perpetual growth model that we just learned in its scary form that the math majors and math professors like. The dividend that it's paying now times 1 plus the growth rate divided by the expected rate of return minus the growth rate. That's the previous model, the previous slide. And then we add this term to account for the growth for a number of years. Yeah. Again, do you have to know this? No. It just takes the model that we just saw, the constant perpetual growth rate, and takes it one step further, adding a term to account for constant growth for a number of years, just as the constant perpetual growth model, the one we just did, added a term from the zero growth model. And then, to make things even worse, we have the two-stage dividend growth model on slide 33. And you see I have all kinds of nasty little things, bombs and nuclear devices and burning and stuff. This is also called the variable growth model. Folks, I'm not going to ask you this, folks. I don't even want you to do it. Many decades ago, Benjamin Graham warned against using overly sophisticated mathematical models to value stocks, especially any kind of model that removes judgment from the equation. Yes, this model may look very impressive, especially to you math fans, but it has some serious problems. It is very difficult to accurately predict future dividend growth during the initial fast growth stage of a stock because dividends are not that important to the company. They're trying to grow the company first, then we'll pay dividends. Usually, companies do not pay significant dividends while they're growing quickly. So ignore this. But the reason I show it to you is, one, it's in the book, and secondly, I show you that because it's just stocks and that's where the money is, people go to great lengths to come up with models and the like to justify why they made their decisions, and then when they make a bad decision, they can blame the model and and not blame themselves. Slide 34, observations of the dividend discount models. Well, let's ask a simple question. How do you use them for a company that isn't paying any dividends? And the simple answer is, you can't, right? At least the current models that we've seen, you can't use them because if a company is paying $0 in dividends, then its effective value is 0 because put 0 in for the dividend for all the models and you wind up with 0. The constant perpetual growth is usually unrealistic assumption except for those very small number of large cap companies, and it's not that small, but the vast majority of companies are small and medium-sized companies that just don't have the ability to grow their dividends like the big companies that have been out there for decades. Dividend growth rates, too, are very difficult to estimate, again, unless you're looking at these large cap, well-established companies with their roots deep in the economy. Then the historical growth rates may be useful. I feel they are useful for those stodgy, boring, what Peter Lynch calls the stalwarts. We discussed that in Chapter 5. But with fast-growing companies in new industries, it's almost impossible. I mean, for years, Microsoft was sitting on $60-70 billion in cash, and they weren't paying any dividends, and they didn't want to pay a dividend because that means they would have to acknowledge that they're no longer a growth company. Now they're a blue-chip, large-cap stock that is boring because everybody needs to use Orifice and terrible Windows. And then they decided to pay out $3, right? Boom! Just like that. They're going to pay $3, and they started growing their dividends, and now they're one of the stalwarts. They've been growing their dividends very smartly the last few years. Check them out. The problems of the dividend discount models notwithstanding, dear students, repeat after me. You ready? The value of a stock. The value of a stock is based on the present value of its future cash flows. The present value of its future cash flows. So now you're starting to understand the concepts. The calculations are easy. Do them, you'll see. Oh, I can do this. Make sure you do the subtraction before you do the division. And it's the concepts that are a little tricky. You're deciding what is this stock worth to me today based on what it's going to pay me in the future in the form of dividends. It's very cool, dear students. It's very cool. It's what we prudent, long-term stock investors are looking for, in my humble opinion. Now, I want you to go do worksheet number 1 and worksheet number 2. Do the dividend discount models. What problems are they? 4, 5? Yeah, 4, 5. Not 6 yet. So, and this is when we would do this in the face-to-face class, all right? And because when we come back, oh boy, are you going to see something so cool? You're going to see how we can use the dividend discount models not only to value stocks that are paying dividends, but we can use a form of the discount model to value a stock that's not paying any dividends. And we're going to see why Payano keeps saying 3, 4, 5 years, and why we like mutual funds with a stock mutual funds, that is, with a turnover rate of about 25% or 20 to 30%. It's all coming together, dear students. Stick with us and be awesome, because we want you to be very wealthy. We want you to be the best investors the world has ever seen. You're now the investment gurus for your family and friends, and I know it sounds like an advertisement, but I'm serious. I'm sincere. We want you to be filthy rich. Kind of silly, isn't it? But it's the truth. See you in our final presentation for Chapter 6, where we do the discounted cash flow model.